Okay, great. So this session is real estate finding opportunities today and tomorrow, and I am very excited to have Carly Tripp here. Carly is the Chief Investment Officer for the Americas at Nuveen in the real estate division. She is a top five global real estate manager with over $130 billion of assets under management. So I'm sure she's got a lot to say about the state of real estate right now. So we'll jump right in, but I just want to tell you first, we want to hear from you in the audience. So you can use the session chat to your right to ask Carly questions, and we'll try to get you to them if we can. So Carly, considering all the trends that have been accelerated or shifted by the pandemic, what stands out to you as having the most lasting impact on commercial real estate?
Yeah, thanks, Karen. Thanks for having me today. There have absolutely been trends that have shifted as a result of the pandemic. And if you take a step back and look at those, the common thread is, of course, technology. The pandemic forced us inside of our homes, and we had to really get creative to change our behavior and adapt. So clearly at the top of that list is e-commerce. E-commerce usage and adoption accelerated very, very quickly in demographics and states that had been very slow to adapt previously. And as a result, e-commerce sales are up 40% year over year. That's further strengthened the industrial sector, and we expect that trend to continue. On the other hand, we hear a lot of talk about the future of office and is office dead? Working from home, businesses had to find solutions to have full connectivity to their employee base. And customers in a home environment, Microsoft Teams, WebEx, Zoom, all onboarded and expanded really rapidly to enable business continuity. Healthcare real estate is another example, similar dynamic with doctor visits. Early on in the pandemic, no one wanted to step into a doctor's office or a hospital. You saw emergency room visits decline drastically. And as a result, teledoc and e-visits all taken hold because that was really the only option. So the list goes on and on. The biggest takeaway for our business is that we have to provide solutions for our tenants, enabling integration between the built world and technologies, so we're not just sitting on the sidelines waiting for disruption. Disruption is here. It was here before COVID. We've just had to adapt more quickly than we previously thought.
So when you think about some of those big changes, it seems like e-commerce is just going to continue to accelerate, but how about the office space shift? What inning of that evolution do you think we're in?
What inning? I'm really, really terrible at sports analogies, Karen, but I'll go for it. I would say maybe the fifth or sixth. I think most corporations, small and large, are reassessing their space needs. You know, they're finding that A, they need less dense space within their office, and B, for certain jobs that are focused on throughput and output and have clear measurable output, those can be done at home. But I think as a culture, we like to engage, we like to interact, we like visibility into our employee base, and we like accountability. And culture, in my opinion, trumps all in business. So when I'm asked that question, I often ask people if they're satisfied with their kids doing school from home. And do they think they're getting the same level of engagement and same level of education from home that they would if their kids were in school? And I think that answer is no. And for me, as a senior manager, I think that answer is no for office workers as well.
So you touched on having to evolve for sort of to accommodate your clients. How has your strategy shifted as a result of that?
Yeah, our strategy really hasn't shifted. We take a data-driven, thematic approach to investing. Pre-pandemic, we were very focused on identifying shifts in consumer behavior patterns, population migration patterns, shifts in technology that could all be disruptive to our industry. So it's been really several years we've been focused on overweighting logistics, housing, and alternative sectors like healthcare and life science. We're also focused on increasing exposure to Sunbelt markets and markets like Salt Lake City that offer lower cost of living and overall a higher quality of life than some of your coastal cities. That's another area I think technology has changed. Companies no longer have to have their staff in one location. There are of course benefits to that, and some prefer that. But depending on your company and your culture, being geographically dispersed to recruit a more diverse talent pool and provide optionality to your employees is important. And I see the younger generations taking advantage of that more and more. So I think COVID has only illuminated the strategic rationale for the sectors and markets. We were growing in pre-pandemic. We don't intend to change that focus. That said, as with any cycle, there's ways to augment your tactics. And if we start to see temporary dislocations where markets or sectors are disproportionately fractured, but those opportunities, we will take advantage of those opportunities, but those are going to be on the margin and not our focus of growth.
Let me switch around a little bit. So when I look at, I see real estate equities, and those of course have gotten really hit hard, but what I don't see is private real estate transactions. And so what happened, what is the disconnect, if there is one, between the public market and the private market transactions, and what sectors are seeing the widest disparities?
Sure. So generally, market sentiment in the private market is consistent in terms of relative value between sectors. So you've seen, just like in the mass public equity markets, you've seen kind of winner and losers emerge. The winners being industrial, data, telecommunication-driven strategies, manufactured homes, senior living, skilled nursing. Those are all pricing at premiums to their underlying values. Alternatively, you still see a lot of discount in the public markets within office and retail. So at Nuveen Real Estate, we're pretty fortunate that several accounts can benefit from holding REITs and do have the option to do that, both for diversification purposes, also for liquidity purposes. So if we start to see major discounts in underlying asset values within sectors that we like, we will buy public equity. And at the beginning of COVID, we did implement that strategy. On the other side of the coin, there are areas that we think we can get more discounted pricing in the private markets. So industrial would be one of those areas where we can buy a higher cap rate on Main Street than Wall Street and prefer to do that. And so buying direct real estate really is our primary focus and strategy. We have good on the ground execution teams with sector expertise that can execute. We'll kind of play on the margins where we think there are clear disparities, but generally it's not part of our larger strategy.
Mm-hmm. Okay. So what are you seeing then in the debt markets? Are you able to, is financing available and easy, or what are you seeing?
Financing is available. It's, again, I think, a story of the winners and the losers. It's the same thing you're seeing in the public and private markets in terms of lender sentiment. So very, very strong appetite in pricing for industrial and for housing and some of the alternative sectors. The pricing gets more expensive for office, retail, and office. I think lenders really are focused on the underlying credit quality of the tenancy and the duration of the leases to price that. Otherwise, they're really, really kind of struggling with how to apply an accurate valuation within those sectors as the market foresees some near-term, ongoing correction on the demand side within those sectors.
Mm-hmm. Let me just feed in a question. It's a little better question than the one that I had for you from one of our attendees. It's from Carlos. I don't know how to PR. I hope I didn't ruin your last name. Do you think economic stimulus will lead to inflation and that this will reflect it in real estate prices, and in what time frame?
That's a really tough question, and I'm probably not the person to comment on that. I would ask our chief investment strategist or economist on that. Stimulus so far has not driven inflation as they had expected, particularly this stimulus that was provided coming out of the GFC. Now, the level of stimulus they're now providing is unprecedented. But ultimately, if you look at the Fed's target for inflation and where inflation is trending directionally, I'm not seeing a big push there. If inflation were to come through, it's actually beneficial for real estate, because then the underlying contractual obligations of the tenants, the rents, would ultimately increase, pushing values further. So real estate is a very nice inflation hedge, so we're not concerned with that at the moment.
Okay. Let's switch to some of the losers. We're seeing a lot of bankruptcies in retail, and as you said earlier, e-commerce usage is accelerating. So what happens to this sector going forward?
So this is a tough one. And first of all, I'd completely acknowledge the fact that this is going to be an issue in the near term. But when I hear people talk about retail, it's done in such a binary way. I think it's really over exaggerated. It's like we're planning a national funeral for every retail center across the United States. Now, that said, historically, the US is, over retailed per capita compared to similarly advanced economies. Due to online shopping, bricks and mortar is at risk for technological disruption. But as I mentioned earlier, e-commerce sales have grown 40% year over year, but still they represent only about 15% of total retail sales. And you see big box retailers like Target and Walmart and Lowe's having massive surge in revenues. And why is that? It's because they've come closer to developing a true omnichannel experience for their customers. They have bricks and mortar stores that really also serve as last mile distribution centers. So you have these big box retailers trying to quickly compete with Amazon's technology and distribution capabilities, while Amazon's trying to play catch up to their footprint and accessibility and proximity to their customer base. So it's our opinion that true omnichannel solutions will win. That does not mean the sector is going to die. It only means it's going to be reinvented, and that will lead to some pain in the short term. I can probably comment on some of our experience in China. So China is at a later phase in this pandemic than we are in the US. And we own several outlet malls across China. And right now we're seeing unprecedented sales at many of our outlet centers. So this early notion that we would see a catch up in pent up consumer demand is playing out in China. I think that Prada reported double-digit sales growth in China recently and is exceeding last year's totals in a post-pandemic world. And similarly, Americans like to shop, they like to socialize, they like to gather. Once we return to being employed and Americans feel safe, retail will return, same stores among the sector.
Do you think that some of the strength in that Chinese retail market is big Chinese shoppers who will willing and able to spend a lot of money, who might normally come here but haven't been able to do so? Do you think we will start to see any flow from that Chinese shopper coming here?
So the first part of your question, I do think that is part of the reason that sales have increased so drastically. So we are used to the Chinese consumer supporting markets in the US like Hawaii, like Las Vegas. We're used to them supporting markets like London. They are very strong on tourism, and they like to shop when they travel. And so with those limitations, it's generating more of a push to spend in their local economy. Do I think they will return? Yes, it's just going to take some time, but it's our opinion that within the next year or so, once we get a handle on the vaccine, everything will relatively be back to normal.
So what are you seeing from the CDC's eviction moratorium? How is that affecting your assets and tenants?
Yeah, so this is a really difficult situation for Americans, especially those employed by the service economy, which does constitute many of the residents that live in our apartment projects. So the CARES Act went a very long way to enable people to pay bills on time. And what we find is that Americans want to pay their bills on time. They take pride in meeting their obligations, especially in paying their rent or mortgages. So I think while the CDC moratorium on evictions does help those tenants, and the strategic rationale for it makes sense, because the last thing you want is increased homelessness or overcrowded, poor living conditions. It does not address the revenue side of the business for landlords. And so it will make it difficult potentially for smaller landlords to meet their obligations. It'll also make it difficult for the tenants to repay their debt, because it does not address what happens at the end of their lease when they have deferred debt and debt piling up.
So will this then, like other industries, have the big surviving and becoming more and more powerful, and the smaller real estate owner really being in somewhat of a bind and not being able to compete?
I think that all depends on policy. It all depends on what is going to happen with this next round of fiscal stimulus. And I say what is going to happen in an affirmative way, because I do believe it's important and it kind of has to happen at this point. And so there is a lot of discussion in Washington right now around how to support that industry, how to support the tenants, how to also support the owners, how to also support the lenders. And so I'm confident that regardless of who is elected in November, they will do the right thing for the American people. And ultimately, it's a very bifurcated story, depending on the state that folks reside in and whether they can access employment or not. So unfortunately, it's very uncertain right now. I don't have clear conviction on the subject, but I do feel comfortable saying additional support is necessary at this point.
You're a global investment manager. So do you have any insights from other markets?
Sure. So, I mentioned China, and obviously consumerism is very big in China and has returned strongly. In other markets across Asia, we're seeing, very interesting dynamics as well. So if we look globally, I think the takeaway is really, again, to understand real estate and its trajectory, you have to understand the culture and consumer behavior. So looking at Tokyo, Singapore, Hong Kong, people are moving again, and we're starting to see trains getting crowded during peak hours, even though some level of social distancing is still in effect. Another factor
is going back to an office.
They are. So another factor in these cities is they're very densely populated and have very small living spaces, and some tend to be very hierarchical. Really important for people to be back in the office and interacting with management, and that is what we're seeing now. Same thing. Countries in Europe, office usage has really returned to 80% levels, and for the most part, folks are back in the office. So a city like London, that depends on tourism, while hospitality and retail have suffered, for the large part, they are back to work.
And how about in other places? Are you seeing the interest in exodus from more urban areas to more suburban, or are we sort of most pronounced in that light?
Yeah, I think that exodus probably started a couple years ago. Again, I think the younger generations are preferring, outdoor activities and a climate that promotes those outdoor activities and healthy living. That seems to be more and more important to people. And so if you looked at population migration forecasts, there was a lot of movement to the Sunbelt markets, also to the West Coast. However, the West Coast has now suffered probably more than anywhere else in the country as a result of COVID, largely because they remain in some hybrid version of a lockdown in certain cities with very limited opportunity to work, to go to your office, even to go to a doctor's appointment. At the same time, some of those locations have the highest rent and living costs in the US. So it really doesn't make sense right now for people to remain in those markets when they don't have access to the amenities and lifestyle that you typically want by living in a large city.
Well, I think, yeah, the particularly California exodus is that, to go back to a sports analogy, I'm thinking is in the early-ish innings. So yeah, we'll see.
Yes. I don't
so let me ask
that.
you a strategic question about how you think. When you're looking to deploy new assets, is it more interesting to you to look at the really beaten down stuff that just you can create such a bearish case for it and prices are really reflecting that distress? Or would you rather look at the things that have really worked, industrial or something like that, that prices have moved a lot? And so you're certainly not getting what appears to be a bargain, but which of those two areas is more interesting to you?
So I think, I mentioned earlier that our long-term growth plans and strategy hasn't changed. We still feel very strongly around logistics, housing, and alternative. We are asset selectors. We're not necessarily asset allocators. And what that means is we have a team in industrial, for instance, that is looking in every market, has very deep and wide relationships across the US. And at times we're buying $10 million buildings, and piecing together a portfolio that way. So we're really looking to markets that have growth opportunity for industrial going forward with some of the supply chain movements that we expect, and also properties that are functionally better than other properties. And so our results there are very, very strong. We expect them to be strong, and that's more a function of execution. The function, be very careful when spaces get crowded, and you have investors with limited expertise driving, capital demand and pricing. So we're extremely cognizant of that, but we think that we can operate around that. Tactically speaking, looking at dislocations, we're having conversations all the time. I think it's going to take some time for those to bleed through the market, but to the extent that there is a tactical opportunity with an operator or a portfolio that we think on a long-term basis is strong and discounted, then we will absolutely transact on those opportunities. They're just not going to be a major part of our growth strategy going forward.
So is there anything you're looking to sell right now? Or is that...
We've been quite active in the sales market. I think that through COVID, the first couple months, the sell market was like really, really depressed. There were really no transactions happening. That's changed over summer and especially post Labor Day. So you're seeing more sales come online. Yes, we are continuing a sales program that we, intended for the year, albeit at lesser volumes than we had anticipated, but we do expect to sell.
Mm-hmm. So you have had a long career, very experienced in the space. How would you compare where we are right now to some of the other crises that we've seen? So for example, 9/11, or pick your crisis, but that would be the one that pops into my head first, or the Great Financial Crisis.
Sure. So, 9/11, I think if you look just holistically at commercial real estate, it was very resilient during that time period. Pricing, depreciation in assets didn't necessarily offset income. And so you really didn't see much depreciation in asset values at all. Of real estate being low volatility and lagging the real economy. When we look at the financial crisis, I think that it was unprecedented in terms of what drove the crisis and then how to remediate it. And so the Fed was really, really clever, I think, in remediating that. And it was successful, but all asset prices during that crisis crashed, right? They become very, very correlated to each other, and they all pretty much went down deep into the double digits, and real estate was no exception. Right now, for the most part, because of the stimulus, both coming from fiscal and monetary side, we have been, pretty solid in terms of our rent collection. So our tenants at our residential properties, our tenants in our office properties, they have the support that they need at this point to continue to pay their rent and obligations. So we haven't seen many cracks there. We have seen less investor demand for certain sectors, which I mentioned before, creates some pricing volatility, but, pretty muted in terms of volatility if you compare it to prior economic cycles or even to the public markets, the volatility.
All right, we just have time for one more. I'll take one from viewer Brian Vincent. Do you have views on either market play, 20 to 22? Do you have views on if it is better to be the bank, private lender only, or be your own bank, use fund capital as down payment and use banks or hard money as OPM, and use skills to manage all aspects? Not sure if that's saying don't go in levered.
Yeah, anytime you expect a pricing correction, leverage can only exacerbate that, but that is a period in time, and our expectation is this cycle is going to be relatively short-lived. However, there will be long-lasting and lingering impacts to some of the dynamics that we expect in the different sectors. We personally are pretty low leveraged within our funds and within our strategies. We have some value add strategies where we will employ higher leverage levels, either, with asset level debt or fund level liquidity lines. And so in my opinion, when rates are so low and debt is cheaper than it's ever been, I am a fan of employing core strategies and using leverage to engineer your returns.
Sense. Carly, thank you so much for your time and your expertise and thoughts. Don't forget to visit Nuveen's Expo booth using the Expo tab on the left of your screen. Now, please return to the main stage. Thank you. Bye-bye.
Thank you, Karen.